Modern investing feels like a trap: endless choices, nonstop FOMO, and pressure from headlines to act now. For most people, trying to beat the market is a losing game. Most people believe complex strategies are required to win at investing, but they often lead to lower returns. I'm showing you the incredibly simple three-fund method that proves doing less can make you more. First fund is QQQ. QQQ tracks the NASDAQ 100, offering exposure to top tech giants. It's a growth-focused ETF, popular for long-term investing. People say QQQ is just tech. Here's the thing. It's actually a system, low-cost, low-churn, and laser-focused on a handful of giants rewriting the economy. If you understand those levers, you'll know when to press buy and when to brace. Let's break it down. Cost first. QQQ's fee is 0.20% versus 0.92% for the average large growth fund. What this really means is you keep more of the compounding. On just $10,000 growing at a market-like rate for 10 years, that fee gap is worth roughly $1,600 more in your pocket. Fees are certain, future returns aren't. Don't donate performance. Next, behavior. Turnover is about 8%, way lower than peers. Low turnover usually means lower trading costs, less style drift, and in taxable accounts, fewer surprise distributions. Translation: QQQ is designed to stay on theme. Now the punchline. Results with risk. Year-to-date daily total return sits around 12.7%. Solid. But the real story shows up over time. QQQ has outpaced its category over 3 and 5 years, about 22% and 17% annualized versus 20% and 14%. What this is telling us: the growth tilt has paid off over real investing horizons. The price? Volatility. 2022 was a minus 32.6% gut punch. If you can't live through drawdowns, you won't harvest the rebounds, like plus 54.9% in 2023. Concentration is the feature and the risk. The top 10 names, NVIDIA, Microsoft, Apple, Amazon, Broadcom, Meta, Netflix, Tesla, and both Alphabet share classes, make up roughly 52% of the fund. What I mean by this: you're making a deliberate bet on platforms powering AI, cloud, chips, and digital distribution. When they execute together, QQQ flies. When they miss together, there's nowhere to hide. Stay tuned. In this video, I will tell you a life-changing hack which will boost your portfolio and double your returns. All right, let's talk about next ETF, VTI, the Vanguard Total Stock Market ETF. If you want one fund that can carry most of your portfolio without drama, VTI is that quiet workhorse. Picture your portfolio as a house. The foundation should be wide, sturdy, and boring. That's VTI. It owns basically the whole US market, large, mid, and small caps, so you're not guessing which sector wins this year. You're buying the winners, whoever they turn out to be. Here's the thing most people miss. Cost is a controllable risk. VTI's expense ratio is 0.03%. That's microscopic. Fees are like termites, quiet, persistent, and devastating over decades. Every dollar you don't pay in fees keeps compounding for you, not against you. And with the picture 2% turnover, VTI isn't churning your money. Less trading often means fewer taxable surprises and tighter tracking of the market you intended to own. How's it doing this year? Good question, but don't obsess over a single snapshot. Year-to-date, it's up around 8 to 9%. Useful to know, not the headline. The real story shows up in full cycles. Look back. 2022 was rough, minus 19.5%, and that's normal for equities. But the market didn't end there. 2023 rebounded, plus 26%, and 2024 followed up strong, plus 23.8%. What this really means is VTI is built for investors who can sit through storms to enjoy the sunshine. If you pair it with a sensible bond sleeve and stay consistent, those drawdowns become speed bumps, not sinkholes. What am I actually holding? Today's top weights include Microsoft, NVIDIA, Apple, Amazon, and Meta, the heavyweights powering a lot of innovation. About a third of the fund sits in the top 10, but that's not concentration risk so much as a reflection of where US profits are being minted right now. Underneath that, thousands of other companies, industrial, healthcare, financials, energy, quietly doing their part. You get the upside of leadership without betting your future on one sector. Next we have is IAU Gold ETF. IAU is an ETF that holds allocated physical gold bars in vaults, You own shares representing a fractional, undivided interest in that gold, not specific bars. Its price tracks spot gold minus a 0.25% fee. However, retail investors can't redeem bars. IAU, the iShares Gold ETF, isn't a growth engine. It's the seatbelt that helps you stay invested when markets get rough. You buy it for diversification and crisis resilience, not for dividends or flashy quarterly wins. Structurally, it's simple and efficient. A 0.25% expense ratio versus 0.81% category average, essentially 0% turnover, and 0.00% yield, because gold doesn't produce cash flows. Those first two KPIs matter. Low fees and minimal trading reduce the permanent frictions that eat long-term returns. Performance explains why investors hold a gold sleeve. Year-to-date daily total return is 29.39%, while the monthly year-to-date series shows 26.17%. Either way, a strong year. Over 1 year, IAU is up 35.63%, category 14.77%. The 10-year annualized return, around 11.35%, dwarfs a broad commodities basket at 3.80%, highlighting gold's role as a monetary hedge rather than a cyclical commodity. But it's not one way. The 3-month line is minus 0.16%, category 5.29%. And there are quiet or negative years: 2021, minus 4.00%, 2022, minus 0.63%, 2018, minus 1.76%, balanced by stress period surges like 2020 plus 25.03% and 2024 plus 26.85%. What that pattern tells us: gold tends to shine when real rates, the dollar, or risk appetite shift, offering crisis convexity. How to use it pragmatically? Size IAU at 5 to 10% of an equity-heavy portfolio. That's enough to matter in sell-offs without dragging returns when stocks run. Rebalance on a schedule, annually or semi-annually. After big gold rallies, trim a bit and feed your laggards. After equity drawdowns, add back to gold or equities per your targets. You're not forecasting, just enforcing discipline so the winners fund the losers at the right times. Set expectations correctly. No income, no buybacks, no quarterly guidance. Your buying behavior. Low correlation that smooths portfolio volatility and gives you dry powder when risk assets wobble. One practical note for U.S. investors: many physically backed gold funds are taxed at collectibles rates on long-term gains, which can be higher than standard LTCG. Plan before you trade. Here's the thing. Every time the market takes a nosedive, people start asking, should I be buying gold right now? Historically, we've seen that when stocks stumble, gold often shines. But let's break it down. Gold ETFs and stocks aren't perfectly inversely related. They often move in opposite directions during turbulent times, but it's not an exact mirror image. What this really means is that gold works best as a diversifier, not a magic hedge that will always go up when stocks go down. Gold earns its reputation as a safe haven asset because in risk-off environments, think recessions, geopolitical shocks, or sudden market crashes, investors tend to shift from growth-oriented equities into something perceived as stable and enduring. Look at history for proof. During the 2008 financial crisis, the S&P 500 sank about 38%, while gold climbed roughly 5%. In 2011, during the debt ceiling crisis, stocks fell around 15% mid-year, but gold surged close to 28%. Fast forward to early 2020, in the COVID crash, stocks plunged roughly 34% and gold rose about 6%. Most recently, in April 2025, when tariff news sent markets into a tailspin, a 20% drop, gold jumped about 6%. What this is telling us is simple. In fear-driven sell-offs, gold often moves in the opposite direction. The key is to have gold in place before volatility spikes. And when a crisis does hit, don't just ride the wave, rebalance. If gold jumps while stocks fall, trimming gold and adding to equities lets you buy low and sell high in a disciplined way. Bottom line, gold can be a powerful diversifier during periods of fear and uncertainty. If you find this video valuable, please like, comment, and subscribe to Wealth Simplified, Finance Made Easy.